The Federal Reserve, often called the Fed, is the central bank of the United States. It plays a crucial role in the US economy and the global financial system. Created in 1913, the Fed's primary responsibility is to promote a stable and growing economy. It does this through carefully managing the nation's monetary policy. The Federal Reserve System is structured as a blend of centralized and regional authorities. It consists of a board of governors in Washington, D.C., and 12 regional Federal Reserve banks located across the country. This unique structure ensures both national economic oversight and regional representation. The Federal Open Market Committee, or FOMC, is the Fed's key policy-making body. The FOMC meets regularly to assess the economy. It makes decisions on interest rates and other monetary policy tools. The Fed's decisions impact interest rates, inflation, and employment levels. They also influence financial markets globally. Understanding the Fed's role is essential for comprehending the intricacies of the US and global economies. Its actions have profound and far-reaching consequences for businesses, investors, and individuals alike. Monetary policy is one of the Federal Reserve's most powerful tools for managing the economy. It involves influencing the supply of money and credit available in the economy. The Fed aims to promote stable prices and maximum sustainable employment. One of the primary ways the Fed implements monetary policy is by setting the federal funds rate. This is the interest rate that banks charge each other for overnight loans. By adjusting this rate, the Fed indirectly influences other interest rates in the economy, such as those for mortgages, car loans, and business loans. When the Fed lowers interest rates, it encourages borrowing and spending, thereby stimulating economic growth. Conversely, when it raises interest rates, it aims to curb inflation by slowing down borrowing and spending. The Fed carefully considers economic indicators like inflation, unemployment, and GDP growth when making these decisions. The Fed's monetary policy decisions have a ripple effect throughout the economy, impacting everything from consumer confidence to business investment. Understanding the dynamics of monetary policy is crucial for navigating the complexities of the financial world. Beyond its role in monetary policy, the Federal Reserve also plays a critical role in regulating and supervising banks. This function is essential for maintaining the stability and integrity of the US financial system. The Fed establishes and enforces rules for banks to ensure their safety and soundness. One of the key aspects of the Fed's regulatory role is setting reserve requirements. These requirements dictate the amount of funds that banks must hold in reserve against their deposits. By adjusting these requirements, the Fed can influence the amount of money available for lending in the economy. The Fed also supervises banks to prevent risky lending practices and ensure compliance with regulations. It conducts regular examinations of banks to assess their financial health and management practices. This supervisory function is crucial for preventing financial crises and protecting depositors. Through its regulatory and supervisory activities, the Federal Reserve plays a vital role in maintaining public confidence in the banking system. Its efforts contribute to a stable financial environment that supports economic growth. Maintaining financial stability and managing inflation are two of the Federal Reserve's most important responsibilities. These objectives are interconnected as excessive inflation can destabilize the financial system. The Fed uses a variety of tools to achieve these goals. One key tool is open market operations, which involve buying or selling US Treasury securities in the open market. When the Fed buys securities, it injects money into the banking system, increasing the money supply and potentially stimulating economic activity. Conversely, when it sells securities, it withdraws money from the system, reducing the money supply and potentially curbing inflation. The discount rate, which is the interest rate at which commercial banks can borrow money directly from the Fed, is another important tool. Lowering the discount rate encourages banks to borrow more, increasing lending activity and potentially stimulating the economy. Raising the discount rate has the opposite effect. Quantitative easing, or QE, is a more recent tool that the Fed has employed during times of economic distress. It involves the Fed buying large quantities of assets, such as government bonds or mortgage-backed securities, to inject liquidity into the financial system and lower long-term interest rates. By carefully managing its various tools and strategies, the Federal Reserve strives to balance the goals of economic growth, price stability, and financial stability. Its decisions have significant implications for the US and global economies.